Hi, everyone. Vice President Alex Madden here with K Properties and Investments. I want to thank you for joining us today for the DST and 1031 exchange webinar. Before we begin, we'll start with some risks and disclosures. DST 1031 properties are only available to accredited investors, generally described as an investor having a net worth over $1 million exclusive of their primary residence, and also only available to accredited entities, generally described as an entity owned entirely by accredited individuals or an entity with gross assets of greater than $5 million. If you are unsure if you're an accredited investor or an accredited entity, please verify with your CPA and attorney. The information herein has been prepared for educational purposes only and does not constitute an offer to purchase securities, DST properties, or real estate. Such offers are only made through private placement memorandums, or PPMs, which is solely available to accredited investors and accredited entities. Securities are offered through Finix, who is a member of FINRA and SIPC. Finix and K Properties are separate entities. This material is not to be interpreted as tax or legal advice. Please speak with your own tax and legal advisors for any advice and guidance regarding your particular situation. There are risks associated with investing in real estate and Delaware Statutory Trust properties, including, but not limited to, loss of entire investment principal, declining market values, tenant vacancies, and illiquidity. Investors should read the PPM carefully before investing, paying special attention to the risk section. Because investors' situations and objectives vary, this information is not intended to indicate suitability for any particular investor. Please speak with your CPA and attorney to determine if an investment in real estate or DST properties is suitable for your particular situation and circumstances. Past performance is not indicative of future returns. Potential cash flow, returns, and appreciation are not guaranteed and could be lower than anticipated. Now, I want to thank everyone for listening in, and I'm going to turn the call over to Senior Vice President Betty Friant with K Properties and Investments.
Thank you very much, Alex. It's nice to be here today. I always like this class, the DST 1031 Basics class we do every Wednesday. We also have another class that we do on Fridays at the same time, 11 a.m. Pacific, 2 p.m. Eastern, which goes into a little more detail on some of the points that we'll be talking about here today. So we'll get started now on the overview, the 1031 exchange first, and then we'll dig into the DST, Delaware Statutory Trust information. So in a 1031 exchange, there's no gain. Well, you don't have to pay taxes on your gain if you were to sell a property you held for business or investment purposes. When you sell that and buy another property that you hold for business or investment purposes, you're allowed to defer the taxes on that gain. So it's a gift from the IRS where we are allowed to take advantage of the tax code, but there are a number of rules that we have to use in order for that to happen. First, we have to have a qualified intermediary. What that means is you can't take possession of any of the funds at settlement when you sell your relinquished property. You're going to be sending those properties to a third-party company who will hold those funds and then eventually send the funds to the property that you're going to be buying. If you wanted to do a complete exchange, you could reinvest all of the sales proceeds into the new property and actually defer all the gains, but you don't have to do that. You could just invest a partial amount and defer part of the gains. So it's something that you'll want to think about, decide whether you want to pull any cash out of your exchange or put the whole amount in and keep it going. If you purchase an equal or greater value that you had, then that would be 100% exchange. There's two dates that are very important. One of them is the 45 days. From the time that you sell your relinquished property, you have 45 days to be able to identify properties that you might buy. And so during that 45 days, you're going to be looking for properties. You're going to make offers on property if they're properties you're going to self-manage. We'll be talking about the DST and how those are available for you to kind of fill in the gaps there. And then you have to close on that property within 180 days, 6 months from the closing on your property. So the timeline works like this. You get your property under contract, you let all parties know that you're going to be doing a 1031 exchange, and then the funds go to the qualified intermediary. You have that 45 days, and in that time you have to actually turn in a list that shows how many properties you might be buying, and then after that 45 days, the only properties that you can buy will be on that list. There's 3 different rules that we use. One of the rules is that you can identify 3 properties of any dollar amount. So if you sold a property for $1 million, you could identify $1 million property and a $2 million property and a $1.5 million property. So that's 3 properties of any price. Or the one we use more often is the 200% rule. And that's where you can identify any number of properties. So if you sold for that same $1 million, you could identify 20 DSTs at $100,000 each, or you could identify one whole property for 100 and then a couple at 200, as long as you don't go over twice your sales price. The third rule is one we don't see very often, and that's called the 95% rule, and that's where you can identify any number of properties at any price, but you have to actually close on 95% of those properties. So again, you have 180 days after your settlement to be able to go to settlement on the properties that you have on your 45-day list. So in a 1031 exchange, the IRS says that you can buy like-kind properties. So that doesn't mean that if you sold an apartment building, you'd have to buy an apartment building. Like-kind refers to the fact that the property that you sold and the property that you're buying has to be held for productive use in a trade or business or for investment. So what that means is you could exchange that office building for an apartment building, or raw land for single family homes, or duplexes for farmland, and you could switch it for a DST, a Delaware Statutory Trust, because they were approved by the IRS as a like-kind property back in 2004 with a revenue ruling. So what is a Delaware Statutory Trust? The DST is a type of property that can be a replacement property for a 1031 exchange, or it can be just a cash investment. So you don't have to be in a 1031 exchange to invest in DSTs. And as I mentioned, the IRS did approve the use of the DST as a 1031 exchange replacement property. And it was a revenue ruling. So it's been around for quite some time now. You're hearing a lot more about DSTs now as they become more and more commonplace. The DST is basically a trust. So it's an entity used to hold title to the real estate. So some of our investors might own properties right now in LLCs or in trusts or partnerships. And a DST is similar to that, but a DST does qualify as a like-kind property. You wouldn't be able to sell a beach house or a rental house and buy into somebody else's LLC or trust unless it's a DST. And what happens during the DST ownership is that you actually receive your pro rata share of the rents. So if you were to own, say, 2% or 5% of a property, a DST is where you own an undivided interest in a larger institutional quality property. So if you owned 1% or 5% of that property, you'd get 1% or 5% of the net rents from that property, and it's paid monthly. When the property sells, you would get 100% of your pro rata portion. So if you owned that 1% or that 5% of the property when it sold, the net proceeds, you would then get your 1% or your 5%. And as it says, this is unlike other forms of real estate equity, private equity syndications, where in some LLCs and limited partnerships, private REITs, some of the appreciation or the profits might be given to the sponsor through what we call a waterfall split or preferred return to the sponsor, where they might get as much as 80% of the proceeds, or typically a half of the proceeds, and half get delivered to the investors. In a DST, it does not work like that. If you owned 1 or 5% of the property, you would be getting your 1% or your 5% of any proceeds when the property sells. When it is sold, when a DST property is sold, because it's just like real estate, you are able to do another 1031 exchange. So when it sells, you could choose to pay taxes on the property. You could choose to do the 1031 exchange. You could choose to go back into DSTs if you had a great experience and you enjoyed being a DST owner. The next time you could invest in more DSTs. You could go back to a self-managed property if you wanted to do that. And now we're seeing also a lot of properties that sell, a lot of DSTs that sell that might offer what we call an up REIT, where you could go from the DST and into a REIT, a real estate investment trust. So that's another way to invest, and you might ask your K Properties representative about any DSTs that might have the up REIT option upon the sale. It's called a 721 exchange, and there's no taxable event when that happens. When you do a 721 exchange into an up REIT, there's no taxes that would be due on that sale until you sold your REIT shares, and at that time, that's when the taxes would be due. So what do I like about DSTs? Exactly this. The no more day-to-day management headaches. And a lot of us investors have owned properties for years. And so what we've done is dealt with the tenants and the toilets and the trash and the calls in the middle of the night. But with the DST, there's professional asset management in place, which means we don't have to worry as much about managing our own properties. There's someone else looking out over that type of management, which frees up our time to do what we really might like to do. And this picture looks like a lot of fun, actually. The diversification is something that's really going to be talked about a lot as you're looking at DST properties, because what you get to do when you have a DST is diversify. So instead of putting all of your money into one self-managed property or putting $2 or $3 million into a triple net property like a Dollar General where you own the building, not the business, but the building, and you're the landlord there. In this case, you get to diversify across asset class, across tenants, across geography, so all your dollars aren't in the same location, and even across the sponsor companies, the companies that actually put these together. So we're going to be looking at a typical minimum investment of around $100,000, spreading out the equity across different asset classes. Sometimes if you have debt on your property that you sold, you'll have to buy debt on the property that you're exchanging into. But if you don't have debt on the property or you're doing a cash investment, you might look at some of our all cash debt-free properties that we offer. And again, the multiple geography really comes into play because any one portion of the country might have an event or something going on like New York City during COVID, where you would be glad to be diversified across the country. And of course, diversification doesn't guarantee profits or guarantee against losses, but it is an interesting way to invest, something you'll want to be thinking about. At the end of the year, most of us are thinking about this right now. For tax purposes, what you're going to be receiving is not a K-1, but what's sometimes called a substitute 1099 or a grantor's letter. And this grantor's letter gives you the top line. The 1099 is the gross amount that your portion of that building brought in. And then you also get an operating statement, an income and expense statement that you'll then take those numbers, your CPA will put them on your Schedule E, just like any other rental property that you might have. So you get the top line, the 1099, you get your expenses on those expense lines on your Schedule E, and then the bottom line, the net, is what you actually got during the year. And it's all done for you, basically. It's not where you have to gather receipts and turn them in and make all your additions and subtractions. It's because it's a DST, it is prepackaged and sent out to you for your CPA to fill in the blanks. So if you have a property where you have a loan on it, so let's use that $1 million sale price again. Let's say you had $700,000 coming out of that property, but you owed $300,000 on that property. When you do a 1031 exchange, you have to replace your sales price. So that means if you had a sales price of $1 million and you had 700 coming out, you have to use that 700,000 to buy $1 million worth of property. Now you could bring 300,000 to the table, or you could invest in DST properties that already have the long-term financing in place. And because it's already in place, you don't have to worry about getting that loan in or making sure you can get a loan on your property during that short 45-day windows. The DSTs with debt typically have long-term financing. It is 100% non-recourse. And what non-recourse means is if there were a problem and the lender had to come back in the case of default, then they can only look for the subject property. They can only look for that asset. They can't come to you for any of your properties or assets. The lender can only look to the property for any comfort there. The DST basics of a loan: when a DST property has an amortizing loan on it, would you get your portion of the principal pay down? And the answer is yes. That investors would get any pro rata portion of the principal pay down. So when it sells and the loan is less, there might be a larger profit. No guarantees, but there could be. And typically a DST will have a loan to value of anywhere between, I'm going to say now, 40 to 55%. 50 to 60%, yes, there's a lot of them in that range, but typically 40 to 55% would be where we're going to be seeing it. And so with the different properties that have different loans to value, we're able to customize a portfolio to make sure that you are getting your debt replaced and you are still then able to invest in any debt-free properties that you might want to do. And we'll show you how that works in a sample portfolio, a sample DST portfolio. So if you have a situation where you know what you might be getting from the sale, ask one of us to fill in a sample portfolio for you so you can see how those numbers work. So why would you consider all cash debt-free properties? If you don't have a loan, or if you have dollars that you've already replaced your debt and now you have just dollars you can invest, if you don't have a loan on the property, you never have to worry about refinancing. So if interest rates go up to 12 or 14 or even 17 or 18% the way they were back in the 80s, you won't have to worry about that. Also, this is kind of a confusing one. Number 2 here says that it eliminates the risk of taking on equal or greater debt in future exchanges. And what that means is, going back to that $1 million sale, if you were to invest $1 million into DSTs that had 50% loan to value, you would have 50% loan, 50% down. So $500,000 down, $1 million down, $1 million loan, and you would be investing in $2 million worth of that property. So the next exchange now, you have to replace that sales price. And so you have to replace $2 million. So you can't go back to just saying, well, I only want to replace the 1 million. Once you add debt to it, it sticks with you for the future exchanges. So in the debt-free properties, you can do that sample portfolio to show you how some of the properties might have to go into debt to replace your debt while others could stay debt-free. You never have to worry about having to sell too soon. If you have a property with a loan on it and the loan is coming due right in the middle of a recession, that might not be a good time to sell, but you might not be able to refinance, and so it could force a sale at that point. Sometimes loans will cross-collateralize the properties that are in that DST. So a DST doesn't have to be just one property. A DST could be a portfolio of properties. So we'll want to make sure that if you're looking at properties with loans on them, that you understand whether or not the properties are cross-collateralized, meaning if one sells, they all have to sell. And then certain properties will have a cash flow sweep. What that means is if you, at a certain point in the loan, if they haven't sold the property yet, the bank may be allowed to hold your money until the property sells to make sure they get all their money back. So they would sweep your rents into a lockbox and hold it for you. It happened once, I think it was when Family Dollar and Dollar Tree merged. I believe their credit dipped a little bit at that point, so certain lenders were able to institute a cash flow sweep and hold investors' rents. And that was when I was doing triple net sales, so selling whole properties. They were able to hold the rents until the situation resolved itself. Sometimes a debt-free DST can have a higher cash flow because there's no monthly debt service. You never have to worry about a lender foreclosure if there's no loan. Yes, a property could go vacant at some point, and that could be a big problem if there's a loan on it, but it's not so much of a problem if there's no loan on it. You wouldn't be getting rent right then, but you're not going to lose the property to a bank because there's no bank. And then the balloon note. Most DSTs are typically going to have a 10-year term. Some of them are shorter, so we will point that out, want you to know about that if it's a shorter loan. But at some point, there's going to be a balloon mortgage payment. And again, if interest rates are high at that time, that can be a problem. No penalties. If you don't have a loan, you don't have to worry about prepayment penalties or what's called defeasance or yield maintenance, just the penalties that happen if you want to pay it off early. And again, they can often have lower fees. You typically can close within 3 to 5 business days after the paperwork is turned in on a DST. And the reason for that is all the third-party reports, the appraisals, phase 1 environmentals, property condition reports, financing, estoppels, everything has been pre-packaged for you. So you're basically looking at properties that are on the shelf. And so you don't have to worry so much about that 45 days because you can choose quickly from properties that are available. Now, we don't want you to choose quickly. We want you to educate yourself over time, especially if you could start before your property is even under contract, or at least when it first goes under contract, so that you know which properties you might be interested in. There's different kinds of DST properties. Some of them are portfolios. We could have multifamily apartments alone or in a portfolio. Triple net properties are where the tenant pays for the taxes, insurance, and maintenance. And so you could have one triple net property or net lease property or a portfolio of those. Medical office buildings are really popular. Government leased buildings like IRS or somebody like that might be in a building. You have debt-free and you have the leverage properties. And then there's another animal called a zero coupon, which is a little trickier, and you'll call us to ask a little bit about that if you are interested. If you have high debt on your old property, the relinquished property, then you might want to look into a zero coupon property, which is where all the money from the rent goes to pay the bank because it has a very high loan to value on it. Again, we can explain it in greater detail if it's something you think might be a good fit for you. You have to qualify. In order to buy a DST property, you have to be accredited, either an accredited investor or an accredited entity. And accredited investor is someone who would have a net worth of greater than $1 million, not counting their primary residence. You could also have an income qualification, so it's either or. If you don't have the $1 million net worth, not counting your home, then as a single person, you could have income of $200,000, and as a married couple of $300,000, and still qualify as an accredited investor. An accredited entity is one where they have assets over $5 million. So if you have a trust or a partnership or an LLC and it has gross assets over $5 million, then that would be considered an accredited entity. And if it doesn't have gross assets over 5 million, then each person, each individual investor in that entity has to be accredited. So your CPA or attorney can help you verify, and we can help you with some guidelines to find out if you qualify or not. I'll run through a couple examples of some typical DSTs. FedEx is a very popular DST property, and we've had a number of FedEx Ground, FedEx Distribution, FedEx Express properties available as DSTs, and try to pick markets where it's a growing market, where they're much needed, where they are delivering. In some cases, it can be right next door to an Amazon distribution center or another Ford or something distribution center. So very popular building. We have properties, multifamily properties. They can either have debt or be debt-free, like this one in Nashville, right next to or right near the Google data center that was just being built there. Pharmacies, Walgreens, CVS's are very popular for DST properties. Gives that long-term lease, sometimes escalations in the primary term. Frito-Lay was over here in Dulles, right near me in Washington, D.C., just a distribution center. Distribution centers are really popular right now with all the deliveries going on. Again, a Texas FedEx medical office are really in demand as well. It could be something like a Fresenius Kidney Care or maybe DaVita Kidney Care. Both of them are strong tenants with long-term leases. A plasma company where they collect plasma to be used in the biotherapeutics business. We have data centers sometimes. Periodically, we'll have a data center. Some of them have already gone full cycle. Going full cycle means it was bought as a DST, investors invested in it as a DST, it was held for a number of years and then sold. That would be something that went full cycle. I mentioned multifamilies. Amazon is a guarantor and a tenant in some DSTs as well. What really sets us apart, though, at K Properties, though, is our due diligence process. We have a team that is comprised of members who have done DST due diligence research analysis for sponsors, private equity firms, international real estate companies, just across the gamut. And we get information for our due diligence from many different sources, whether it's us going to visit the properties or databases that we subscribe to, the third-party reports. But we always start with the first part of it, which is we're just not going to offer certain asset classes. And some people say, well, gosh, senior care like nursing homes and dementia care and assisted livings are so popular now, and we're all getting older, but there's just so much litigation, so much legislation right now in that we just think it's not maybe the right time to invest in senior care. Same with regional shopping malls, hotels, not yet. We don't do oil and gas. We don't do saltwater drilling. We're not recommending student housing yet, as a matter of fact. It's just an asset class that just is too much. You can still have something go wrong in a plain vanilla property, but when you start adding in these, it better be a great big return to make up for the risk of something. But we're not typically seeing that. We're typically seeing someone might say, I'll give a 0.5% more return for something that is what we might consider very risky. So when we have properties, it could even have 25 single tenant net lease properties in one DST, and we're going to try to mystery shop every single one of those, send someone to see every single one of the properties that we have on our database. And so we just think it's important to visit the property, and I don't know of many other people or any others companies that will do that with virtually every DST property that we work with. We also, in our due diligence process, have what we call sensitivity analysis and stress tests. So what that does is allows us to understand how many people would have to move out of an apartment building before they couldn't pay the rent, the mortgage payment. So we want to make sure that we understand things can go wrong, but how likely would it be to go wrong? And so we try to look at that when we do our due diligence. And then we look at the lease, because we're real estate people, so the real estate information is really important. We're not just selling this like someone might sell a stock or a bond or a put or a call or something like that. These are regular office, retail, industrial, multifamily. So the lease is really important because it can affect the property's value, not only now, but also in the future. We want to know if there's something included in the lease, like the fact that the tenant, it says it's triple net, meaning the tenant pays for all the expenses, but sometimes it would be a double net where they're responsible for the roof and structure, or they might have the ability to leave, say something like a McDonald's in front of a shopping center. If a Target goes vacant, if the Target closes down, sometimes the McDonald's doesn't have to pay their rent, or it might have a rent holiday. There's lots of things that are in a lease that we look for that other people who aren't really real estate people might not know to look for. Sometimes it's even as simple as, is it a ground lease, or is it a fee simple ownership, or is it what's called a leasehold? And in a leasehold property, you don't even own the land under the building. All you own is the building. And so we'll sometimes see a DST that's just a leasehold. And if you don't understand real estate, you're not going to understand that once the lease is up, your income stream is up because you don't own it anymore. So it's kind of interesting. But the third-party reports give us really detailed insight into the market, into the building itself. So in summary, what we are doing is trying to dig in and deconstruct the property using all the different tools we have in our toolbox to make sure that if it's a bad deal, it doesn't matter, what happens, it's still going to be a bad deal. So we're trying to make you aware of that. Some properties we think are a little higher risk, and so we might have the a flag on the property saying risk awareness, but that would be something that would be, it would go along with your risk tolerance. You might like it, and we don't think it's that bad, but we want you to understand that maybe it has a short-term financing, or maybe there's a cash flow sweep in it, or maybe it is a single tenant with debt, which means there's only one person paying the rent. So anyway, we'll walk you through all those types of things to think about when we do the K Properties process. And what this is us giving you guidance in your exchange. So we first want to understand your situation. We want to understand what you sold for, whether you have debt, what the timing is, what your preferences are, whether you live in an income tax-free state or not, what you like, what you don't like. And from that information, we're going to develop for you that sample portfolio I mentioned earlier, where we will have some initial recommendations for the investments. And it's really just a starting point, and we can change it. We can add properties in and out. We can change the numbers around. We can really do a lot once we get one plan on the books. Then from there, we really grow it into something that would really be a good fit for you. And then as we do that, we're going to be talking about the pros and cons of each various DST. We're going to be looking at the PPM, that's the private placement memorandum, and that's where we look for every answer that you might ask. If you're curious about the appraisal, or curious about the third-party reports, or how fast is the area growing, we're going to be looking to the PPM for that kind of information. And we can even set up sponsor calls. We call them. The asset manager will get on the phone with us, or we can schedule a property tour for you to see the properties that you're interested in. We, as a team, K Properties team, you can come to meet us if you like. We are headquartered in Los Angeles, but we have offices in New York, Washington. I head up the Washington, D.C. office, San Diego, San Francisco, Seattle, Boston, Dallas. We are working for you and with you, and we work as a team so that you'll have one of us there with you, kind of holding your hand the whole way. Once you finish with your transaction, you will have had a transaction coordinator assigned to you. As I said, hold your hand through every step of the way. And we work with the qualified intermediary and with the closing agents from the various sponsor companies to make sure that your closing is just very easy, simple, transparent. And after the closing, we want to keep you as a client for many years. So we're going to be providing you with updates and keep answering any questions you might have, making sure you're getting the information you need from the sponsors. So you will use us as a resource for understanding the market. When do we think things might sell? When do we think we might have a full cycle event? So you will be with us for years to come. And there are lots of reasons why clients choose to work with us at K Properties, but here are 10 of them. One of them is that we are hyper specialized. DSTs are what we do. We don't do puts and calls and insurance and mutual funds and oil and gas, or even your financial planning. That's somebody else's job. We are specialists in the real estate, in the DST, which is real estate wrapped in a securities wrapper. So we help you with your exchange, we help explain things, and by sticking with a company like ours where we specialize, I like this last sentence, it's where you're going to a specialist for a knee or a hip replacement instead of a general practice doctor. We do real estate. And as I mentioned, our offices were licensed in all 50 states. We've done over $30 billion worth of DST participation, and we have 150 years of collective real estate insurance. Collective real estate experience. So we're just a phone call away. We are picky, as I mentioned. We don't do the types of properties that we think are high risk. You could go out there and buy them somewhere, but we just think let's be vigilant and try to understand the risks before you do that. We have off-market properties, and you'll really be surprised at the number of properties that we have that are only K Properties exclusive, are exclusive for our clients. And a lot of those are the debt-free properties. So you'll want to ask to see our off-market properties. And then we also have the regular on-market properties. So we'll be showing you a lot of different sponsor companies who are putting together these properties. They have to own it before we can offer it to you. So it really is just a good way to be able to do a 1031 exchange with properties that are just there waiting for you to choose. Again, we don't do the higher risk asset classes, even if they pay a higher fee. We have anywhere from 15 to 30 DST offerings at any given time. So you can see our DST properties at kpi1031.com. You can call us and we can email you or send you a hard copy of our inventory. There's probably at any given time, let's say 15 to 20 different sponsors. And so, as I said, some of them will have portfolios with 10 to 25 properties in them. So we make sure that we've looked at each one, not just on paper, but in person as well. We have the leveraged properties that would be for folks who either want the debt for some reason or have to replace debt in their 1031 exchange. The loans are already in place, so you can go to settlement very quickly. There's no sense in some cases for leaving your money at the qualified intermediary because you're probably not earning very much interest there. So you can start your pro rata share of the rent as soon as the sponsor company gets your dollars from your qualified intermediary. Again, I mentioned we probably have more debt-free properties than any other company that I know, and it is worth looking at debt-free properties if you don't need debt. We walk the walk. We are personally invested in DST, so we know what it looks like to get the monthly rents from the sponsor companies. We know what the year-end tax paperwork looks like. And so we can give you advice based on what we've seen, what we understand, what we're doing. And it's a good way to invest for me, maybe not for you, but for me, I've owned properties for a long time and I don't want to really manage them anymore. So that's why I came to the DST world, was to be able to do this for my own portfolio. Again, just to briefly sum it up, we have headquarters and offices around the country. We're specialists. We've done thousands of DST exchange investments. We have 150 years of real estate experience, 30 billion in DST real estate transactions, licensed in all 50 states, references, deep relationships with CPAs and attorneys and qualified intermediaries across the country. And because we work as teams, we're available to help weekends and holidays whenever you need us. If I happen to be gone, my team will be there and one of us can get back to you. So it is a big team. We are a big team. We have what you need to make your life easier under one roof. Dwight Kay is the CEO and founder. Shay Lappin is our president. We have Jason and I are vice presidents, but we have chief financial officers. We have on-staff counsel. We have on-staff CPAs. We have marketing. We have transaction coordinators where people are there to hold your hand if you have a question about a DocuSign or something. Accountants and asset managers. So we can get you the information you need through our team here at K Properties. You've probably seen DSTs out in the marketplace now, and lots of articles by K Properties and about K Properties. You might have seen in Forbes, the New York Times, 1031 Exchange Times, Virginia Business, and 1031 Digest. So be watching for properties. And if you go to our website, you'll be able to read a lot of the articles that we've written, see replays of the webinars that we have on Wednesdays and on Fridays, read white papers, almost any topic that you could think of, you can go into our blogs and read more about it. So you'll really want to get into our KPI1031.com website. So I will invite you all to call us at 855-899-4597 or go to our website, KPI1031.com, to look at our current inventory. To ask one of us to give you a call, you can click on the Calendly link to schedule a time or call one of us, and we would look forward to talking to you and helping with your exchange and standing by. Thanks very much. Have a great rest of your week, and we'll talk again soon.